In today's video, I'm going to be talking about the one mortgage hack you need to understand so that way you know how to best negotiate your next real estate offer. My name is Seanu Uyehara. I'm an area manager with Geneva Financial, and I created this YouTube channel to help you understand the mortgage world and make sure that you get the right mortgage. If you have questions, need a pre-approval, refinance questions, you can always hit the description below. There's links to more information of how to get a hold of me, and I'd be happy to hop on a call with any of you. Now, the market is shifting yet again. Welcome to the lovely world of real estate. Things are never the same for long of a period. We're starting to see in some markets across the country where sellers are willing to negotiate a lot more. And I think we're in that time of the year where, again, sellers may want to close on a house before the end of the year for tax reasons. So you as a buyer right now, I think it is an amazing time to purchase homes. We said this last year where a lot of incentives were being thrown out there to get buyers across the finish line. And we're starting to see the same thing happen again as we shoot this video here in the beginning of November. So one thing I really want you as a buyer to understand of what you could be looking at as you get into this home is the seller credit and how to best apply it. So many times real estate agents or buyers will want to beat the seller up on price. You see a home that's listed for an extended period of time. Your immediate gut reaction is that the house is not worth the value. So let's offer less, whether it's $10,000 less. Some people like to lowball them even more, but I want you to look at this strategy instead, because I think this will save you a ton more money in the long run and probably help get your offer accepted a little quicker. So I want to show you this breakdown that we have here on my screen. So I just took an arbitrary example of a $400,000 sales price. We're putting 20% down on this home, and we're borrowing $320,000 with an 8% interest rate. This is someone with 700 plus credit score, a primary residence. So we're just using just a rough number to go over these examples here. So our estimated principal and interest payment and taxes and insurance on this home would be about $2,600 a month. Okay. That's if you bought the house at $400,000. But let's look at column number 2, which says price reduction. This is what most folks will typically do when they see a property. Like I said, you see a house listed, you want to go beat the seller up on price, which is fine. So let's just say you offer that person or the seller $360,000. So a $40,000 price reduction. Again, you're putting 20% down. You're now borrowing $288,000. Again, still at 8%. Your principal, interest, taxes, and insurance payment comes out to $2,383 a month, or a savings of $264 a month. Pretty good deal, right? You got the seller to come down on price. You got your home. Your payment's a little cheaper. Awesome. Think that's a win. But this is where I want you to think outside the box. And if you're a real estate agent watching this, this is a strategy I think will help you win offers quicker. And if you're a buyer, share this video with your realtor. And if they have questions, they can always contact us directly and we can show them how we can structure this for you. So instead of beating them up on price, what you want to do is offer the list price of the home, but use some of those seller concessions in order to buy your interest rate down. So in this specific scenario, I'm going to ask for a 6% credit from the seller. So again, we're going to give them the $400,000 sales price of the house that they have. We're going to put our 20% down, but with our 6% credit that the seller's willing to give us, I'm going to use a portion of that money to do a 2-1 buy down, which is a temporary interest rate buy down. So year 1 in my mortgage will be at a 6% interest rate. Year 2 of my mortgage, my rate will go from 6 to 7. And then year 3, my mortgage will go from 7 to 8. To today's market rate, and it stays fixed at 8% for the remaining 27 years of the loan. Now, why I would go with this product is because, one, I get a cheaper payment in the first couple of years. Now, so many of us are under the impression that interest rates will come down, and we're all hoping. No one has a crystal ball to say it's going to happen on a specific date, even though there are some people out there that do make these types of predictions. But we would all assume at some point rates should come down. Now, there's no guarantee to that, but let's just go with this product for now. For the first couple of years, we're taking a cheaper payment. So we're putting our 20% down. Year 1, our mortgage payment is going to be based off the 6% interest rate, which would give our principal, interest, taxes, and insurance payment down to $2,218 a month, or a $429 a month savings. This is great because, again, we are getting in at a cheaper payment today, and we're going to be able to maintain that over the first couple of years. And the benefit of the temporary buy down is that if interest rates do come down and you are able to refinance, any of the funds that are prepaid into your escrow account to get this lower interest rate, you get to use that as a principal buy down and help offset some of your closing costs when you do your refinance. So many of you are opting for permanent interest rate buy downs today, but the problem with that is you're throwing money away, because if interest rates come down next year or in the next couple of years, you're going to throw away all that money you paid up front. So this is why I'm not a huge fan of permanent buy downs, especially in today's market, unless you look at the break-even analysis and that point of breaking even is far enough out that you will stay in the home so that you can recoup that cost. But I think for the most part, most people will probably refinance or do something within the first probably 5 years of your mortgage. This may be a little different with where interest rates are today. However, we are seeing more and more people want to refinance and lose the 2 or 3% interest rate that they've had, because as we know, people are drowning in credit card debt. So this might be a way to further extend the dollar, that the credit you can get from the seller to make the deal work. Now, why this offer is more attractive to the seller is because instead of asking them for a $40,000 price reduction, all we are needing is to utilize 6% to get this interest rate down, so the seller will net more money with our offer. Now, if you're in a market where you have multiple offer situations, this is what the seller is going to look at. They're going to determine, where do I net the most amount of money? Then they're probably going to look at who's the lender. Are they reputable? Is it a big bank, small bank? Is it a bank we've never heard of? Some of those factors will play a part as far as whether the seller wants to deal with you. So this will give you a leg up if there are multiple offers, because you're going to net the seller more money, and the credits that you get as the buyer, you can apply them to get you an even lower interest rate. Now, in order to get this same payment of $22.18 a month, you would have to negotiate the seller down from a $400,000 sales price to $326,000. So almost $74,000, you'd have to negotiate that down at an 8% interest rate to get the same payment. So again, this is where this strategy can be so beneficial down the road. And I want to show you on a 2-1 buy down how this works. So in year one, like I mentioned, you have a 6% interest rate. You're at $22.1856. Year two, your rate would go to 7%, and then your payment would go to $24.28. And then in year three, your interest rate would be 8%, and then your payment would now be $26.48. So there's a slight increase every year. But again, the whole thought process behind this is that you can get in for a cheaper payment for the first 24 months in hopes that you would be able to refinance. Now, the one thing I will say, you have to understand that just because you get into your home, there is no guarantee that you will qualify for a refinance down the road. This is something that so many lenders and real estate agents, they were just talking about this marry the house, date the rate thing, but no one ever talked about the refinance. So understand that just because you buy a house today does not guarantee you a refinance down the road. The lender still has to qualify you. We're going to pull your credit. So if your credit goes down the toilet in the next 2 years for whatever reason, you probably won't be able to refinance. I've had clients that have called, or people off of YouTube that have called me that have missed credit card payments and they want to refi. But when your credit score drops 100 points, you can't do anything. And now you have derogatory items on your credit report, and it's going to be really, really difficult for a lender to get you financing. Now, so many of you will buy a house, then you go buy a vehicle. Again, your debt to income ratio could be higher than what it was when you bought your initial house. We have to take that into account. And you have to qualify for this refinance down the road. And most importantly, your house has to have some equity. We have to have the right loan to value in order to do the refinance. So just like we pre-approve you to buy a home, you still have to go through some sort of approval process when you do a refinance. It's not just, hey, Sean, I want to refinance my house today. We got to make sure you can actually still qualify. So the whole purpose of showing you this is that there's better options that you can get into a home. And also you can take some of the credits versus getting the seller to always reduce their price in order to help you get a more manageable payment. Now, if you were to take this 6% credit, and let's just say you wanted to do a permanent buy down, I'm going to show you kind of a breakdown of what that looks like. So if you were to get 3% from the seller, in our rough scenario that we're talking about today, you can probably get a 7.5% interest rate. And this is your principal and interest payment, $22.37 a month. Now, if you were to use 4% of that, you can buy your interest rate down to 7.25. That would then take your payment to $21.83 a month, right? You can see that right there. You're talking maybe $50 a month in savings. Not even a huge amount of money. If you got 5% from the seller, you wanted to apply that to a permanent buy down, you can get your rate down to 6.875%. Some of you might be getting excited about that. You can now see that payment is $21.02 a month. And let's just say you got 6% from the seller in credits. You wanted to apply the full amount towards your interest rate buy down. Takes you to 6.625, takes your payment down to $20.49 a month. So the thing that you have to understand when you're looking at these permanent buy downs is what's the break even, right? So how long do you plan to stay in the house? If you're going to stay in the home for 2 years, none of these scenarios will probably make any sense to you because you're going to sell, you're going to refi, and all this money that you're putting towards the interest rate buy down, you're going to lose that. So what I would do in those situations is try to protect more of your cash to close. Let's cover your closing costs for you. And then if we have any other funds over and beyond that, then sure, let's look at an interest rate buy down. But so many times people get thrown into these mortgages because the number one question that most of you have when you shop for a lender is, what's your interest rate? What's your interest rate? So most lenders, the way they structure their loans and the way that they reply to you is by trying to quote you a low interest rate. But to get a lower interest rate is typically going to cost more money to do that. Now, in this case, let's just say the 3% that you would pay to get 7.5%, you're looking at a total of, in our scenario here, let's do some quick math. This could be $9,600 and our payment's going to be $22.37 a month. Now, let's just take it down to the 6% and let's use the full 6% that towards our interest rate buy down, which is going to be a ton of money. So $19,200. And again, that takes our payment down to $20.49 a month. So you can see the difference between the $22.37 minus our $20.49 is only $188 a month. But when you look at the overall cost to do this, the difference is $9,600. So when you're looking at the break even, you're looking at 51 months. So the question to you would be, is it worth saving an extra $188 a month to spend another $9,600 to do that? Again, your break even's 51 months. If you're going to stay in the house longer than that, you're not going to refinance, you're not going to touch your mortgage within that time frame, then yes, maybe it would make more sense to spend the money up front now to get a lower interest rate. However, most of you probably don't even look at this. Your loan officer, unfortunately, probably doesn't break it down to show you your options. And I could probably guess that most of you, $188 in savings is not going to change your life. So this is where, again, the right strategy to maybe for this person, let's save more of your cash to close. Let's protect more of that money because you can probably go invest more of that money than saving $188 a month. And I know $188 is not going to be a huge savings because most of us don't budget and most of us probably don't even account for things like that in a budget. But this is where, again, just understanding the numbers, what makes the most sense, looking at the right strategy and having the right conversations with your loan officer and your real estate agent can make all the world of difference. Because imagine if you could save an extra almost $10,000 to buy your house versus just throwing money away to get into your home. And what if interest rates come down in 6 months? I can guarantee you this person would refinance. If rates were in the fives, this person would refinance. So that $10,000 that they just spent, that they were so up in arms about getting the lowest interest rate, I need the lowest rate today, you threw that money away. And that's how you make bad financial decisions. And again, these are things that we perpetuate over and over and over again when we buy, sell, refinance homes. So this is where our team, we specialize in doing these analysis. We want to know how to best structure the deal for you so you can win. Now, if you like this example or you are buying a house or doing a refinance and you'd like me to do something like this for you to see how much money we could save you, I'd love to do that. Shoot me an email and let's talk. Thanks for watching. I'll see you on the next one.